One, the debt ceiling, fears of a recession, and a regional banking crisis. Those are headlines that have dominated the news, and we're going to talk about those and their impact on the real estate market here in our spring market update and forecast. I'm Brett Jennings with Real Estate Experts, and here's what we know for sure. How do concerns of a recession affect our real estate market? Well, what about the collapse of Silicon Valley Bank and other regional banks? And what does that mean for our home prices? Well, to put it in summary, what we can say about the real estate market, it has been incredibly resilient in spite of all of this economic uncertainty. In fact, for the first 4 months of the year, home prices rose a total of 6.1%. And the fact that prices have risen year to date is evidence of a significant pent-up mortgage demand despite high rates and ongoing affordability constraints. That's from Doug Duncan, Senior Vice President, Chief Economist of Fannie Mae. So here's what's happened. Prices in Silicon Valley and the Bay Area peaked about a little over 1 year ago. This is looking at a 3-year chart of price per square foot for homes throughout the Bay Area, specifically Santa Clara County. And we can see prices peaked March 18th of last year at $964 a square foot. And here's what we know. Interest rates last year went crazy. They started out in January at about 3%, and by the end of the year had more than doubled. We hit 7% in November, and they came down a little bit. We ended the year at 6.5%. And what did that do? Well, that caused prices to come down because when rates go up, affordability gets compressed and prices have nowhere to go but down. And prices came down a total of 10.7%. You may have seen that if you checked Zillow for your home price or just when watching the market over the last year. Now, what happened was prices actually bottomed in January. So rates got up as high as 7%. They came down a little bit in the month of January, and that spawned buyers to come back out into the market, and they've come out in full force. This is what's happened with prices since the beginning of the year. They are on their way back up and are approaching last year's previous highs. What is driving prices? Well, it's historically low supply. We have very, very few homes for sale. In fact, what we're seeing here is a 4-year look back to inventory or supply of homes for sale. And what we can see is that supply has been trending down every single year. And this year has been no exception. What's causing this low supply this year? In fact, we have 45% fewer sellers bringing their homes to market. Well, this is it. What we're looking at here is what the current interest rate is for the average property owner in Silicon Valley or the Bay Area. What we can see is that close to 24% of people who own a home have an existing mortgage of an interest rate less than 3%. Another 40% of homeowners have an interest rate between 3 and 4%. What does that tell us in total? That means 60% of homeowners have a prevailing mortgage, their existing mortgage rate is under 4%. Now, if you've got a low interest rate, and even if you do have a desire or maybe even some need to move, and you found that perfect house, you might not be so excited about getting out of your 3% mortgage to go buy a new home with a 6% mortgage. And that's exactly what's causing the holdback of inventory on the market, causing close to half of what would be normal sellers from putting their homes on the market. So with the low supply is one side of the equation. The other side of the equation is strong buyer demand. And here's what we can see when we look at the data, where we try to get a forward look into where the market may be going or where demand may be, is we start to look at what is the traffic that we're seeing at open houses. And this graph we're seeing here shows showing traffic looking all the way back in the last 12 months. And what we see is the red there is 2022. That's what was happening with showing traffic. As interest rates kept going up, the number of people going through open houses was going down. But at the beginning of the year, we saw interest rates dip, and that spawned a whole new wave of buyers to get out and into the market. So you can see there's a steady increase between January, February, March, April, and even May now. Every month, there's more and more buyers out shopping for homes. Now, when we take a look back at the last few years, what we're seeing is that the showing traffic at open houses is increasing far more than the traffic we saw in the years leading up to the pandemic, and almost approaching the level of interest in traffic we saw during the pandemic. So we have this really low supply and strong buyer demand. So what's driving all of that interest this spring for buyers? Well, we still have a really strong job market. That's providing a solid foundation for housing. Bottom line is jobs drive real estate. And this is what we see with the national job market. In 2023, we saw 165, in March of 2023, we saw 165,000 new jobs. In April of 2023, we saw 253,000 new jobs. So strong upward increase in the number of jobs available in 2023. Now, you might be saying, well, that sounds like national numbers, but how does Silicon Valley compare? Because I've heard friends getting laid off and there's a lot of layoffs happening around Silicon Valley. Well, here's what we find to be true. In spite of layoffs, hiring is still very strong. In fact, according to SiliconValley.com, San Jose metro area tops the nation in the fastest pace for hiring. This is looking at the unemployment data, looking back over the last 20 years from Silicon Valley Index, okay? So when we look back at what our average unemployment is in and around Silicon Valley over the last 20 years, it's been about 5.7%. Where is it today? If we look at the far right of the graph there, where for Santa Clara and San Mateo counties is our green line, it's about 3.5%. So we're still well below our 20-year average. And by the way, for unemployment to get to any place where it starts to have a meaningful impact on our real estate market, it needs to get between 6 and 7%. So unemployment needs to double before it would have any meaningful impact on our real estate market. So where is all this job growth happening? Well, we're seeing private education and health services, so biotech and private education is where we're seeing the largest number of job increases. Professional and business services is second, and then government sectors is the third. So that's where the growth is happening. But what does all this mean for you? Well, here is our forecast for this coming summer. What can you expect for the real estate market? We expect interest rates to trend down as the Federal Reserve eases their policy. We've started to see early signs that inflation is trending down, which is a positive sign. It's not exactly where they want or need it to be, so rates aren't going to drop tremendously over the next few months, but they will come down a bit. That, along with the demand that we see, demand will increase as our job market is still growing. Supply is going to stay low for the reasons that we mentioned. Interest rates are still relatively high, and so we have fewer sellers that will be putting their homes up on the market. And all of that, the low supply and the high demand, will cause prices to continue to rise, is our forecast, somewhere between 3 and 5% between now and the end of the year as demand exceeds supply. So if you're considering buying, we are forecasting prices will go up. So the time to get into the market is now. If you're considering selling, prices are close to near all-time highs. There's very low demand, so what that means for you is a high price and a relatively quick sale. So whether you're buying, selling, or investing, the market is still moving. We encourage you to reach out to the person who shared this video with you and get your questions answered. Until we talk, again, this is Brett Jennings saying we'll be right here ready to help you create a better life through real estate. Have a great one.